Our important market voice for the day, Saurabh Mukherjea of Ambit Capital, joins in with his sense of the fundamentals. Saurabh, it's great to have you on the show. I think this is our first conversation after the rate hike that surprised many on the street. Not all, because I think a minority in the market believe that the rate hike was pretty much on the cards. What do you make of this rate increase? Put it in conjunction with what's happening across the globe, where the Fed may move faster on rates, may step up on the pace this year. ECB saying, we will scale back on QE. Even markets like Hong Kong are, going ahead with rate rises. In that sort of context, what kind of policy expectations would you have on domestic turf?
I think it was back on 5th January that we said that India will hike rates through the summer. So we weren't at all surprised to see the RBI hiking. My reckoning is that we'll see another rate hike in the next 3 or 4 months. I know the RBI gave very sort of upbeat guidance regarding its inflation outlook. It almost gave neutral guidance on inflation outlook, but I don't think we should take that too seriously. It's pretty clear that inflationary pressures are building up. You can see core inflation is already pushing 6%. That doesn't include oil and food pressures. And as the Fed itself steps on the rate hikes, the rupee will come under further pressure, which in turn generates more inflationary pressures, because as the currency slides, it leads to imported inflation into India. So I think we are in that phase of the economic cycle globally, where growth picks up. Growth is clearly picking up in India as well. But as growth picks up, inflationary pressures build up across the world, partly because of commodities, partly because of demand outstripping supply. We're seeing both of those in India. I think the added dynamic in our country is fiscal pressure. I think as in an election year, as is the norm in our country, in an election year there tends to be a degree of populist spending, which in turn adds to inflationary pressures, in turn adds to the need to hike rates. So I wouldn't be surprised if we see at least another rate hike in the next 3 or 4 months, and then between now and the fiscal year end, say 2 hikes. So one in the next 3-4 months and one through the winter.
Saurabh, hi, morning. So how is this macro setup really going to spell for equity markets? Because what we've seen is an attempt by the side market, which was just so, beaten down the last 3 months, or since the budget, I should say, make an attempt to recover, but not quite out of the woods, while, there's that serious polarization in the market, and the index is what, just 3% off from its all-time top?
That's right. So I think what we have seen and will continue to see is pressure on small and mid caps. Small and mid cap companies typically don't have that much pricing power. So when raw material prices start pushing up and cost of money starts pushing up, these companies cede operating margin. We saw that in Q3, we saw that in Q4. I'm pretty confident through Q1, Q2, we will see small and mid cap companies suffer operating margin pressure. So I think the pressure on small and mid caps will be relentless, and high time. I think there's clear overvaluation in that space, and I think market cap migrates into large caps. Within large caps, we've already seen IT stage a recovery. I think as you were discussing, Pharma is overdue a recovery. A sliding currency, the rupee typically gives 4-5% a year. The last 4 years have been an anomaly. The rupee hasn't slid since August 2013. It's almost 5 years of rupee not sliding. So we're clearly overdue a fairly major slide in the currency. That sort of environment plays right into the hands of IT and Pharma stocks. IT, as we said, already recovered. I think Pharma is overdue a recovery. FMCG volumes pick up as the government throws money at rural India in preparation for the elections. So we see a reversion to IT, Pharma, FMCG away from small caps. The one big sector which should have cracked a while ago hasn't cracked in the last 8-9 months, but I can't help feeling a major correction in financials is overdue here. I'm talking about wholesale market dependent financials, companies who borrow money in the wholesale market and lend to the retail customer. The wholesale market rates have tightened by 125, 130 bips in the last 6 months. I think there's further tightening in rates coming in the wholesale market, and I can't feel that a major correction in NBFCs and HFCs is around the corner.
Okay, so when you say this impending correction, that's going to only restrict itself to NBFCs and some of the HFCs, right? You don't think that it's going to maybe trickle through to some of the private banks?
No, so anybody who borrows heavily in the wholesale market, right, whether you're a private bank or you're a housing finance company or you're an NBFC, if you're borrowing in the CP or the CD market, 3-month, 6-month money, and lending for 20-year home loans or 5-year developer loans, I think you have a challenge now. Last July, exactly a year ago, I think our wholesale market rates bottomed out. Since then, they've been rising. The rise in short-term money market rates has picked up pace in the last 6 months. As inflationary concerns build up, as the fiscal deficit conditions become more pronounced, I think we will see further tightening in the money market, which in turn poses a problems for either banks or NBFCs who borrow in the wholesale market. CASA funded banks which have strong CASA franchises, I think are in much better shape to deal with it. So whether you're public sector or private sector, if you have a strong CASA funded franchise, you're in a far stronger footing than lenders who borrow in the CP and CD market and lend to retail customers or indeed to real estate developers.
Is there a contrarian theme that you're propagating right now, Saurabh, in this sort of a market environment? Because I think the theme that the consensus would fall upon would be to do with rate rises. So, you know, all the sectors related to that sort of a trend in the making would be in focus. But anything that you think would stand out aside of financials in this sort of a market environment?
I think if you look for contrarian themes, I think there's two ways to think about contrarian themes. One is, I think metals and mining in our country is set for a sort of long positive period, and that's partly because of this insolvency and bankruptcy code, which I think will create a duopoly in the ferrous sector, and in the non-ferrous sector we already have sort of almost duopoly type conditions. So in both ferrous and non-ferrous, we'll end up with 2 or 3 dominant players with very little new supply of coal or of mines coming on stream in India in the next 3-4 years. So if global prices of metals and mining stay hard and harden further, and domestic supply of fresh commodities becomes hard to generate because of supply side factors, regulatory factors, I think our dominant players in ferrous and non-ferrous could be set for a really good 3-4 year run. On the bearish side, I think auto as a sector, a big part of the auto boom in the last 3-4 years was funded by loans given by NBFCs. As money from NBFCs becomes dearer, I can't but feel both on trucks and cars, we will see a slowdown in the pace of growth, which in turn leads to derating of auto stocks, trucks and cars. I think two-wheelers are in better shape. Two-wheelers are more linked to rural India, where if the government throws money at rural India, as it is doing, I think the two-wheelers could stay in that two-wheeler volume growth could stay double digit. But I think car and truck volumes seem superheated, and I think a slowdown there would be more likely than not as money gets dearer.
For IT, Saurabh, you mentioned your views on IT as a sector, but do you not think that the best perhaps may already be behind us? I know the currency tailwind is still favoring the entire IT sector, but if I just look at the trading screen, most of these names are already sitting at life highs, be it an Infi, TCS, or even some of the smaller ones like a Tata Elxsi, Hexaware, etc. The move has been very sharp.
Yeah, but you got to remember that our IT companies historically were plays on two specific factors which got switched off for a period of time. If the rupee stopped depreciating, these companies lost a big part of their competitive edge, right? If the rupee starts again depreciating steadily at 4% a year, which is the long-term average depreciation in the rupee, if the rupee again goes back to that trajectory of 4% a year slide, I think these companies benefit big time. Remember, they are competing for Fortune 500 or S&P 500 companies contracts, they're competing with the Western majors. If they get a 4% cost advantage every year, that's a killer competitive advantage vis-a-vis the Accentures and IBMs of the world. So I think consistent rupee slide is great news for the IT firms, and hence watch the rupee very carefully. If the rupee pushes through 70, I think IT will have a great time. And the second piece is the Western economic, the state of the Western economies. If you have a strong economic recovery in the US, which is what the Fed is saying is underway, Europe in reasonable shape, Japan in reasonable shape, the underlying market conditions for the IT firms becomes better. So yes, I know technology has changed and there is artificial intelligence to contend with, but a sliding rupee and a recovering Western economies is good news for IT firms. I think there's further juice there, but I would say pharma is the other sector where there's a major recovery overdue. Very similar dynamic. Our pharma companies didn't really have sort of cutting edge science. They were plays on cheap drugs. They were cost efficient drug producers. The rupee gives these companies become super competitive in the regulated markets of Europe, America, and Japan.
Even though you've spoken about pharma and you're saying it's a theme that's getting popular, what within pharma will hold out? Because even if their relationship with the US FDA is now improving, there is a fair amount of competition within EMs for providing low-cost supplies to the mother market in the US. Given the new drug pricing regulation that may be in the works, the healthcare bill that they're propagating. So when you look at the different business models in India, where do you think, despite high R&D costs, will they be able to generate high returns on investments?
Yeah. So I think there's two different themes to be played in pharma. One is an emerging markets branded generics play. So within EM, you also have India, you have Latin America, Brazil, specifically Brazil in Latin America is the largest market. Then you have Africa as well. So there's a bunch of Indian companies which are fairly good at this. They're branded generics players. Their market caps anywhere between $2 billion to say $4 billion. These are reasonably large-sized, well-run companies, strong track records of delivering 20-22% ROC in EM conditions. I think that story has held up actually reasonably well in the last 2-3 years, and I think that will continue to have a good run. So this is branded generics for the EM market. A different story, as you're rightly alluding to, is selling into America, where there was a whole heap of FDA related issues with the Indian companies not having plants up to the FDA standards. I think the majority of those issues are behind us. I'm sure we'll still get a rap on the knuckles for a few pharma companies going forward, but the majority of the FDA related issues I suspect are behind us. And if the currency starts giving pretty consistently, starts sliding by 4% again, which is the long-term trend of the rupee, 4% per annum slide, I think the competitiveness of Indian pharma companies in the American market is taken care of. I can't emphasize enough how much of a tailwind consistent rupee slide was for Indian pharma and IT companies till August 13, and how much of a disadvantage these firms have faced in the last 5 years as the rupee hasn't slid. Our exporters generally, in totality, our exporters have been rendered uncompetitive by the strength of the rupee in the last 5 years, and as the rupee goes back to sort of its old-fashioned consistent sliding, our exporters once again will become very competitive. To not play that theme at a time of rising global rates, rising inflation in our country, to not play the currency sliding theme would, I think, be a little foolish at this juncture.
On consumption and particular Saurabh, FMCG, a lot of analysts that we've been talking to, they're saying that it's Bharat that they're betting on and not India when it comes to FMCG plays. Would that be your tilt as well, more towards the rural specified plays, the Daburs and Maricos of the world, given that it seems like it's going to be an on-time arrival for monsoon, it's already hit the shores of the country, the southern parts that is, and clearly the government's tilt is that towards more spending for the rural segment, it being an election year, and we can already say that play out with some of the SOPs coming in for the sugar sector already.
Yeah. So first, let's look at what we've already seen. I think last 2 quarters, especially Q4, we saw the first quarter of double-digit volumes growth across the FMCG pack, barring 1 or 2 names, right? It's been a long time since we've seen such healthy volume growth numbers across the piece for rural India. Now, if we look forward, my reckoning is in the next 50 odd weeks, right? So roughly 50 odd weeks to getting the election done. I think we're going to the government's going to try to spend $1 billion a week on rural India. Between supporting crop prices through MSP and NREGA, you're looking at $1 billion a week getting pumped into rural India. I can't think of a better way to play that theme $1 billion a week infusion into rural India other than FMCG. I think FMCG is your best bet. The other way you could go at it is through the two-wheeler route. Two-wheelers also I think will have a good run. You're absolutely right, the monsoon looks in decent shape. So if you add up decent monsoons, $1 billion a week getting pumped into rural India, I think FMCG stocks are as well placed to recover their sort of halcyon days of 13-14% volume growth. I think the FMCG stocks are as well placed as I've ever seen them in, say, the last 5 years or so. So play the standard Indian theme of heavy spending in rural India approaching a general election. Alongside there a good monsoon. I think these stocks will do well.
Okay. Right. You know, Infosys completes 25 years as a listed entity today. And in a bit, of course, we will be touching base with Mullah Bhansali, who managed the IPO way back in 1993. How do you, I know we've spoken about IT, we've spoken about how the rupee depreciation is the, you know, the near-term trigger for the sector, gives them competitive advantage. But, you know, do you think that for Infosys in specific, as a leader, as one of the leaders of the sector, that the road ahead looks clear or still a bit bumpy, given all the challenges they've faced in the last 5 years? So out of 25, 20 years were great, but you know, the last 5 have been a bit up and down.
Look, I can't make any company-specific comments, but I think in generality, the road ahead for Indian IT services companies is pretty clear. They generate a lot of cash. They pretty much have to return all of that cash to shareholders every single year because it's not apparent what they'll do with the cash. It's not apparent there's a great need for fresh capex or fresh investments on the part of Indian IT services companies. So return your cash on an annual basis, and if you have a big war chest of cash sitting in your balance sheet not doing much, then return that as well. Become high dividend payers. Say if you can give a dividend yield of 5-6% and generate EPS growth of, say, in the high single digits. If they can manage to pull it off, EPS growth of even, say, 6-7% with 5-6-7% dividend yield, I think Indian IT stocks have a sort of good maturity period where they give around 12%-13% a year, half of it through earnings growth, half of it through dividend. Some of our IT services companies have figured this out quicker than the others, but I think gradually they'll all fall into this template of broadly doing what an Accenture does, which is return money through buybacks and dividends pretty generously, and then push the system as hard as you can to get to, say, 6-7-8% earnings growth. I think that's a pretty healthy combination, and it's high time the Indian market also had companies which on a stable basis ground out 12-13% of shareholder value a year for investors.
Saurabh, always great to get your views on the markets. Thanks so much for taking the time out today.
Thank you. Thanks for having me.
Okay, that's the view coming in from Saurabh Mukherjea on a whole host of sectors, stocks that he likes, not stocks, just sectors.